So, you can be either an importer or you can be an exporter, and you require currency, either dollar, euro, pound, or any currency in the world. Now we are covering options. Last time we covered futures, and futures, video is already there, so you can watch if you have missed out before coming to the next class. And if you are an importer, that means you have to make a payment, okay, in dollars. When I say dollar, it means any currency. So I've chosen an example of a dollar. Suppose you have to make a payment in dollars. Normally, when we get goods from abroad, we are an importer, so we normally get time to make the payment. 3 months, 6 months, 1 year, or 2 months, whatever. It depends on how we negotiate it with the supplier. So you have to make the payment. Okay. Now you have to make a payment after 3 months. So you are an importer, and you have to, buy dollar. I mean, you have to make a payment in dollars terms. So you are an importer. Okay. So you have to make a payment of $1 lakh. Okay. When? On say 29th of January. Today is 31st of December. Okay. But you looked at the screen on 22nd of January, and you have to make a payment. We'll cover in 5 minutes everything which we. So you have to make a payment of $1 lakh. Today I'm going to take you to the stock exchange also along with it. Okay. So yesterday we missed out. So you have to make a payment of $1 lakh. When? On 29th of January, which is about a month away from this. So then since you are going for options and not futures, so futures are linear products. Fine. Either you make a loss or you make a gain. Fine. Here also you can make a gain or a loss, but here you can, if the dollar moves in your way, fine, you are an importer. Dollars today is 83. Suppose it comes to 81. You are happy because you have to pay less. So then you don't require any hedging. Fine. So since you have to hedge yourself, you can walk out of the contract. Fine. You only lose some amount of money which you have paid a premium to some other person to get that hedging. Okay. So when you saw a stock exchange, when you went to the stock exchange, so I'll just take you to the stock exchange at the same time. Okay, so then this is an online portal. So we go to currency, and you have to place an order. Okay, you are an importer. Fine. So various options are available. There's futures, then options. So we go to options. Fine. Then I have to make a payment in dollars. So I'll press USD, INR. So I select a contract. Okay. So since I'm going for, I'm importer. So if you are an importer, okay, you have to buy a call option. And as an exporter, you have to buy a put option. Call option is when you are bullish. Put option is when you are bearish. Call option, buying a call option, buying a put option. Of course, you can write a put option as well as write a call option. Then your stance changes from bullish to bearish and from bearish to bullish. We'll discuss that. Okay. So since you are now, you need to pay in dollars, so you think dollar will go up. You're going to lose money in your real transaction, but you want to gain in the stock exchange. So you become bullish. You take just the opposite position in the stock exchange. If the dollar goes up, you make money. So all the money which you make will get offset from the money which you have to pay on the day when you have to make the payment to the importer. So it will basically, hedge you. So any gain in the stock market will, offset the losses in the real market. Okay. So now you have to make a payment on 29th of January. So there are some weekly contracts and some monthly contracts. So we'll straight away go to the January ones. So these are January contracts which are available. Now you will find that the first column is the date and the second column is the strike price. So look at the strike price here. And this is the last traded price of the premium. So premium will keep changing because so many people are interacting and everybody, is trying to, they'll understand what premium is, which is prevailing, the last trade, but that gives you just a kind of a this thing that this is the at which the last trade has happened. Okay. Then action, buy or sell. So then, we move down and because since we have to make a payment on 29th of January. Okay, fine. And if you go down further, you will have February like this, and then it will keep going up. This thing as your date, suppose it is in March or something. So, okay. Spot price is shown right at the top. Spot price 83 rupees 16 paisa. Okay. So this is the today's price of dollar. That means, of course, it was Friday's evening close price. And then, you just reach to 29th of, if you just select a contract, let's see what happens. Okay, yeah. So we will just go back to this. Okay. 29th of January. So we are interested in the January part. So we'll just go to January at the moment. Okay. Now in January, you have to choose a strike price. That is your own choice. It depends upon you what strike price you choose. Okay. And there is one more something called technical analysis, which is also a very essential part of understanding the derivatives. If you have to really trade and do good, because you must know what kind of strike price you should choose, whether the market is bullish or bearish. So it will be the technical analysis will tell you. Okay, I'll explain that in just half an hour, maybe in some time when you do the stock derivatives. At the moment, I'm just not covering the technical analysis, okay, because that's a subject by itself. So you have, on 29th January, you have 80 rupees strike price first. The premium is 3 rupees 21 paisa. Okay, if you look at which is in different color, 3 rupees 21 paisa. Is it visible? Huh? Okay. So the premium is 3 rupees 21 paisa. That means you have to pay 3 rupees 21 paisa per lot. Okay. And per lot is 1000 US dollars. So this is 3 rupees 21 paisa per dollar premium. Okay. Not per lot, per dollar. Okay. So you pay a very good amount of premium because this is deep in the money. Because you choose a strike price of 80 and today the dollar is what, 83. Okay. If the dollar goes to 85, suppose at the end, so you make 5 rupees profit straight away. Okay. So you get a head start, but you have to pay a hefty premium. Okay. Because the person who is charging you the premium, he will like to cover. I mean, he's giving you an opportunity to buy at 80, but then he'll build that price in the options. Okay. That, comfort what he's giving to you. Suppose you choose 81, the premium will go down. Okay. 2 rupees 22 paisa. Okay. Fine. And then we'll understand, later on when you do stock derivatives that these premiums are dependent on a lot of factors. Okay. And there is, there are some models, Black-Scholes model and by other models. So of course we are not going to do that in detail. We are just going to use the calculator and find out this 3 rupees 21 paisa is okay or it's higher. Premium will keep changing, it will change after one. At a particular, when you open the window, this is the last credit price, okay? Somebody, yeah. Yeah, absolutely. So now you're, have a premium of 3 rupee 21 paisa. So you want to know whether this premium is very high or very low. It will depend upon the volatility between the US dollar and the Indian rupee. More the volatile, more the premium. So volatility is very, very important. If the volatility is very high, the premium will be also very high. If the volatility is very less, the premium will fall down. Because the volatility is high, then the person who's giving you a right, as a writer, he knows the dollar can move, in widely, so that, it will be advantageous to the call buyer or option buyer. So he will try to, nullify that advantage. He'll charge more premium. Okay, fine. So he will build in some volatility in the option pricing, and that is called implied volatility. And whatever volatility, which inherent volatility between the US and INR, it's called historical volatility, and we'll understand what it is. Okay, I'll give you an example. I'll show you on Excel how the two are calculated. So if the implied volatility is very high, and otherwise the US dollar is not that volatile against the rupee, that means the premium is very high. So instead of buying a call option, you should write a call option. That we'll learn later more deeply. Okay, fine. So that is just to check, understand, and just you enter the data, and then you know how much volatility the option writer has built into the premium, and then you check the real volatility of the stock or the exchange currency pair. So you find the volatility is only 20%, whereas he is built 40%. That means the pricing is very high. So don't go for a call option.
So writers can choose their own volatility. Only in stock market, only the writers will choose the.
See, when I go and place an order, I can put my premium there. Okay, suppose it is 3 rupee 21 paisa. I put 3 rupee 50 paisa. Nobody can stop me. But then there are so many people. There's enough liquidity in the market, so people will hover around 3.21 or thereabout. Okay, so if I put 350, that means my order will not get executed. As a writer, I will not be able to sell. So I have to bring it down to the current level. Okay, the current level is again decided by all of us. In the market, when you go and you find the rate of oranges, okay, it's 100 rupees a kg. Okay, so you go to the next shop in a wholesale market, he says it's 95. Then somebody says 90 and you will buy it from 90. Then other guy says the other guy is selling at 90, so he'll also bring it down. So that market forces decide about the premium and nobody else. Okay, the stock exchange doesn't decide that. It is decided by the market forces. Fine. So it is 3 rupee 21 paisa is the premium. Now, ideally speaking, you should go very close to the price at which the dollar is trading. Spot price. The spot price was somewhere around 83.16. So maybe 83 rupees or 83 rupee 25 paisa would be most ideal for you. Okay. So here, if you choose, you have to pay 37 paisa premium or 21 paisa premium. Okay. So you may choose even 21 paisa because 83.25, even if dollar moves to 83.25, you have to make a payment at 83 2 point nothing. Heavens are not going to fall. It's already 83.16. So a couple of paisa is not going to play havoc in your transaction. But it is causing a less premium for you. So you choose a less. But if you choose 84.5, then you are missing out because then you are taking the remaining hedge up to from 83 to 83.50. 83 is suppose the current rate 83.16 to 83 84.5. You're taking the risk on your shoulders. If it goes to 84.5, you're not going to make any money. You're going to only lose premium, which it remains there. Okay, so 84.5 or whatever is the out of the money premium, there you're taking some amount of risk on your shoulders and paying less premium. अगर आप सोचते हो कि 90 हो जाएगा तो go for 84.5. So some you bear, some let the other guy bear, the call writer. Okay, but that is not the case. It can go to 19 in a hurry. Okay, so you choose this somewhere near the spot price. Okay, then you say I buy. So it is like you choose like 83 rupees 25 paisa. So you press a buy button. Okay, so you'll get this screen. Fine. Okay, the moment you get this screen, so you're in, your contract name will be USD INR 29 January 83 rupees 25 paisa. C is the call European option. So there are two kinds of options, European and American, and we follow European. Okay, in just to give a flavor a little bit, then we'll explain in more detail. In a European option, in an American option, you can exercise your call anytime you want, up to the time of the expiry. But in European, you have to exercise only at the end, at the expiry. That's a different. Okay. But then you still want to close it early, so there are mechanisms of doing that. In American option, you can close it anytime you want by taking a reverse position, by squaring off your position. But in case of a European option, then there is another technique to exit from the options, even if you want to do an early exit. We'll understand that. Have you learned that? No. Okay. So that is because the tricky part. Okay. So now, you have one lot which is 1,000. So you want 100 lots. Okay. So you'll say 100 lots. Fine. Fine. So then you say you by automatically come limit order. So you can either place a market order or a limit order. When you say limit order, so you can put a limit price of 0.2150. Fine. You can do that, or you can just select the current situation which is there. So let's see, the window is not here. Okay, the best bids and offer prices which are available. So maybe it's coming in. It is there. It is there. This is this is the last traded premium. Look at this NSC 0.2. You can put any number. Okay. Now, how do we decide that number? So you just pull out the screen and see how many people are there. So it will give you the 5 best people who want to buy and 5 best people who want to sell at the same time. And rest of the numbers will be hidden from you. Only the numbers will be given. So if you look at the last line, their total bid lots 16,174. So that means these many lots people are willing to buy and 7,000 people want to sell. Lots they want to sell. So there is more buying pressure than the selling pressure. So you can understand this is like advance and decline line in stock exchange. So here it's 16,000 people who are willing to buy in January. There are 7,000 people willing to sell. Okay. Now, if you look at the buy, since you are buyer, call buyer, so you'll focus on this side. So first is 7 bid lots. So this guy is offering 0.2175. So that means the guy who has placed the order has put at 0.2175. We can even also put that because this is the best offer price. Somebody is saying that I want to buy at 0.2175. Okay, fine. And there is, the second guy which says 2.2150. So it will be in the order. The first priority the order will be placed at 0.2175 because he's offering more premium. The second guy is offering less premium, so he'll come second. Similar, the last one is 3,075 bid lots, where is 0.2075. So that means the 5 best says in the range of 0.2175 to 0.2075. So you can say, okay, there are 5 lots and the least lot is 0.2075. You can place that the order at 0.2075. If you don't want to go further, you can just say, okay, somebody has done, so they are the best 5, so others are, fade bit down. So you can just take your own call. You can even put 0.200 and wait for 5 o'clock or 3:30 before the market closes, and know that whether you got
That
it.
is not assured that your order will be matched because they are just saying the highest of the price.
Otherwise, if you want the order to match immediately, press the market button. Press the market button, your order will get executed. Whosoever is in the line, it will get executed. But because in the dollar versus rupee, there's enough liquidity, a lot of people have placed the orders. So you'll get some price which is very near to it, because the price will be this, which is given on your screen. Somebody wants to sell as 0.200. So the moment you put a market order, the most likely, because he's offering 81 lots, your order will get executed at 0.2200. Okay, fine. Now there are certain instruments like bonds. Maybe not, I don't know now. About 5 or 6 or 7 years back, I was selling a bond. The bond has gone to from 1,000 rupees to 1,200 rupees. So I saw the market price 1,200, and that time I was not knowing about this bid and ask screen. So I said market. I sold it. I said, okay, I made money. I was holding. I bought the bonds at 1 lakh. It was selling at 1,20,000. When I just came back, okay, or I just saw it immediately because I placed the market order. Because the bond liquidity is less, so it takes time to get your order executed. I saw that I got only 1,05,000. So somebody purchased my bonds at 1,005. Though I placed at market price, but there were no other people. So somebody, suppose like, he's intelligent. He saw there is an order, market order. So he punched the order at. I just pressed market because the last market price was 1,200. Somebody played a trick. He was a clever guy. He just saw, okay, because the people are there, very, who are placing the orders. They know bond has very less liquidity. So he offered 1,010 rupees or something, and my order got executed with that. Instead of getting 1,200, I just got 1,105 rupees, something like that. So I lost 15,000 in one stroke, and that is called impact cost. That is called impact cost. It is explained in the books. When you read in books, like you have books, you read, you will never know what it is, because when you suffer it as an investor, you come to know what it is. Because there were no buyers, there were very less people who were selling. So he just saw my order, and he saw there is no other person who has placed the, buy order. So he placed the buy order at a very low price, and my order got matched with him. But in case of otherwise stocks and other things, the markets are so liquid that you will get a very less impact cost, not very high. Because here, when I place the order, the punched order, which is 0.22, this is the only I might have placed the order. The last order price was say 0.21. I will get at 0.220. I may lose only 1 paisa or something like that, isn't it?
So we have to see the liquidity, how much time your financial instrument gets time to execute. We have to be very
Yeah,
careful.
what happens when you are doing it, like you're buying Reliance or any stock, enough liquidity is there. Only the problem comes when you're selling ETFs and bonds. There you must check the liquidity. That's why I prefer not to buy ETF, but ETFs are very liquid otherwise, as it is, made out, because most of the trade is happening in, exchange traded trades and in bonds. The bond market is not very deep in India. Now we can't get, a Reliance bond which is listed on the stock exchange. As biggest company doesn't have a bond which is listed on the stock exchange. Okay, because when we are calculating the valuation of Reliance, so we need to know what is the interest rate, for calculating the back. So that should be the latest, the market rate. So you can't know what is the market rate at which the Reliance is borrowing, because if the bond would have been, rated, they have been listed, we would know what is the yield to YTM. So that would become the interest rate. So we can take that for calculating the value of the by discounting all the cash flows with the back. So that you don't get. So you have to go for the ratings of this thing. Reliance is AAA. Then look at the synthetic ratings given by Damodaran. Of course, that is applicable to America. So apply that. That today, the risk-free rate is say 7.25%. So Reliance will be say 0.5% spread if you are AAA. So Reliance, cost of borrowing will be 7.75 or close to about 8%.
How much of this rating, download rating, is reliable? Is it like working fine? Is it like if you don't have the bond
listed on the stock exchange.
listed in the stock exchange.
So it is like this, if suppose if the government is able to borrow at 7.25, which is the current rate, which is published, which is, you can just go to the trading window and know, okay, that I'll show you. So the bond rates keeps changing, okay, because bonds are tradable in the market. So bonds yield will be calculated every second, and you know at what rate is today. So government next Wednesday when they borrow through RBI, so they will borrow around that price at which the 10-year bond which is trading, or a 3-year bond which is trading, whatever bond they are raising. So they look at the what is the current yield. Okay, so the risk-free rate, which is the current yield, is the government borrowing rate. Okay, if government is today borrowing at around 7.16 or 7.25, so that means a guy like Reliance, which is a AAA rated company, they have to pay at the maximum 0.50 more, 7.75. Like a fixed deposit is close to about 7.5. So if you have a choice between Reliance and fixed deposit, you're going to put money in fixed deposit and not give it to Reliance, because fixed deposit considered to be more, safe. So the most safest is government bond, which is 7.15. Next safe will be fixed deposit. And the third safe would be a company like Reliance or Infosys or Hindustan Unilever, which are AAA. So they may give you a little higher than the fixed deposit, okay, but lower than, they will charge, higher than the fixed deposit, okay. So it's 7.5 is a fixed deposit. So definitely Reliance has to move it to 8%. So, it is as good as that. You make it 7.9 or 8, it is not going to make a big calculation difference in
They
your.
offer more so that they can have the respective.
Absolutely. Suppose if DLF is looking for a loan, then they have to add at least 1.5% over the risk-free rate, because it's a single A company. Fine. So for if you want to give money to DLF, so you may expect around close to about 8.5% to 9. If Shriram Finance is taking, they may charge you, give you 10%, because when you go to the screen and find how much Shriram Finance is offering, 10%. So they say don't deposit in fixed deposit, we'll pay you 10%, because their rating is nothing. So you can
So the
get.
DLF is issuing some bond. So how do they measure the first that at what rate of interest they will have sufficient number of investors buying their bonds? How do they go about? What is the rating you are saying? But
Yeah. The
normally,
first is you look at, at what rate some other company is offering. There are a lot of companies whose bonds are rated. We can go and check. Fine. And their yield is available. Their bonds are listed. Few, but still they are. Okay. So you have to offer a little more, 1-2% more.
similar type of company.
Yeah. And then you check, what was the recent bond which was, issued by some other company and what rate they offered. So it's kind of a, understanding, what is the market dynamics today. And then you, give 8.5, 9, 10, whatever. Okay. Fine. So, okay. So let's come back to this. So this is, you're going to just see the screen and go back. And then you say, I'm going to buy 100 lots. And then you put any premium. Okay. Suppose you say suppose I say 0.150. I don't want to buy. I don't want to place an order where my order should get executed. So I am willing to pay only 0.5. So then I'll say, first of all, I have to see what margin I have to pay. So margin is how much? One lot is 1,000. So it has to be basically, one lot is 1,000. So that means it should be 1,000 at least for one lot. Okay, fine. So it has to be 1 lakh. It is 1 lakh here? No, 1 lakh.
So lots to already
One lot is इतना
one
lot
lot
से अच्छा.
1,000.
Okay.
You can take one.
अगर मैं इसको 100 लेता हूँ, I think okay, 1 लाख ही लेना पड़ेगा इसमें, 1 लाख ही है.
नहीं नहीं सर.
Okay, just
1 lakh.
okay, ठीक है, मान लिया. So premium is how much? 150. So if I make 100, the premium is how much? 15,000. Okay, so this premium I have to pay. Fine, the margin I have to pay. This was what options. Okay. Okay, there when I'm buying. Okay, fine. So I don't have to look at a margin here since I'm called buyer. Okay, the margin will be paid by the call writer. Okay, so here then what all they have to look. Okay, nothing. So I can just place the order. The premium. This is yeah, he has to pay to the call writer. Yeah. So let me just go. Okay, and just go back to my screens. It will be better explained there, and then we come back to the exchange here. So here, when I choose 83 rupees 25 paisa as a strike price, the premium was 0.23. So this was a couple of days back. So premium keep changing. Okay, 0.23 was the rate for expiry January 29. The spot rate was 83.175, which is given at the bottom. So 0.23, which I punched and my order got executed. Assume that. Okay. So number of contracts, 100 I should have put. That is the right number. I should have not looked at the margin when you are buying a stock or something, or when you're, then we look at the margin. Here, I don't have to pay any margin. Okay. Then buy a call option. 100 contracts at $1 is 83 rupees, 25 paisa, the strike price, and the premium is 0.3. I should have added 0.3 here, which is coming here. Okay. Option premium, which I have to pay, is 0.3 into 1 lakh, 23,000. Okay. Is that okay? So that means I have to pay 23,000 to set this trade. So I paid it. And then before I was just telling you, this was the window where you look at, these are the strike prices. Now we have gone to the stock exchange and seen this. So here I choose, it was 23 at that time. So which was ATM. Okay. So this is the screen which we watched. So now what happens is the day comes when I have to make the payment. I don't mind close my position before that. I'll wait it till 29th of January, because that was the date when my payment was supposed to be made. Okay. So I'll normally wait till 29th. I can even do it earlier also. Suppose I'm making a good gain and I think the dollar will go back. So I can even close my position, say on 25th of January or 10th of January or whatever day I want. Okay. So first I'm taking, without adding any complication, I'm saying on 29th of January, I'm closing my position. I want to close my position. So on that day, now all the options are cash settled. Options and futures are cash settled. Okay. ATM, ITM. Yeah. Okay. Just, I think you missed out. You came a little late, or you couldn't understand the concept. Huh. So, when you look at, you have to choose the strike price yourself. Fine. The strike price will range from 80 to 86. If you go to the stock exchange, I have just put a snapshot here. Okay. Fine. And you can see the stock exchange also. You can just see, I'm not going there. I'll be repeating everything. So when you look at the stock exchange, these are for 29th of January, these are the strike prices which are available. Okay. Fine. And the spot price is 83.17. We know that on the day when I entered the trade, it was 83.17, which was, sometime 4 days back when I, was making this slide. So that time the spot was 83.16. Today it is 83.16, and today, that day it was 83.17. Okay. Now I saw there are various, ranges of premium available. So if I choose 80, then I have to pay a premium of 3 rupees 19 paisa, and it is called in the money, deep in the money. The more in the money, it is considered to be much better, but it comes at a very expense. It is very expensive. I have to pay how much? 3 rupees 19 paisa per dollar before I, book my order. तो मुझे 3 रुपए 19 पैसे खर्चने पड़ेंगे. That means 3,19,000 for making a payment of 1 lakh. I'm hedging $1 lakh payment, so I have to pay 3,19,000. If I lose, I'll lose all the entire amount. Okay. If the dollar falls to 79, then I'm not going to exercise my option. Okay. Suppose it comes to 79, then I lose 3,19,000 straight away. But if the dollar goes to 82, I can recover only 2 rupees. Fine. Fine. So I lose 1 rupee 19 paisa. If it goes to 83, it remains there. Then I just recover barely, 3 rupees, and I lose some 19 paisa also. Okay. If the dollar remains there, doesn't move, it remains at 83.17 or 83.16. I have paid a premium of 3 rupees 19 paisa. So that means my spot price, strike price, plus the premium what I have paid, which is 83 rupees 19 paisa. So dollar has to move ahead of 83 rupees 19 paisa to give me some money. अगर डॉलर 83.19 से नीचे क्लोज हो जाता है, I don't make any money, but I can recover some money. Suppose it goes to 82, then I make recovering some money. I'll exercise my call and get 2 rupees from the writer. So I have paid him 3 rupees, I'll recover 2 rupees. Is that okay? Fine. So then if I take a deep out of the money, let's look at the last one, 86. If I choose 86, that means my profits are going to start from 86. Today the dollar is 83.17, so that means if the dollar touches 85.5, I'm going to lose the premium. I'm going to lose the premium as well as I'm going to pay at 85 rupees 50 paisa to my importer. Fine. Because I'm not getting anything. Fine. So if I choose deep out of the money, then I have to pay only 0.0025 paisa as a premium. okay, which comes to only 2 rupee 50 paisa, but it is not hedging my position. But suppose somebody says dollar is going to touch 95, very rare, very, very rare. As a honor possible, there's a war breaks out and nobody can predict a war. Okay, so the dollar may touch 90 or 95. Then in that case, I'm going to make some money. And that is going to be very abnormal kind of a situation. Where should I go for an 86 kind of out of the money? But all ranges are open. You can choose anyone. Yeah, it will be very close to the spot rate. If it is exactly 83.17 strike price is available, we say it's exactly at the money. Or then we call it NTM, near the money. The right word is called NTM. At the money would be 83 rupees 1.7. At the money would mean that I can choose a strike price of 83 rupees 0.17. Absolutely. What you are saying is there's a premium. That means the dollar is going to appreciate. That's for sure. And dollar normally appreciates. You know, when you look at the trajectory of dollar, the dollar has been, going up by 4 to 5% every year. So now it is going up by 1.5% 2 years because the interest rate differential or inflation differential is narrowed down. Okay. So, but there are bouts of ups and downs. Suppose, yeah, but now it is around close to about 1.5. But at times, what may happen that the dollar, Indian rupee may appreciate because we get a lot of money. Suppose come January, okay, we may have a lot of money flowing it from abroad to India. FII investment, FDI investment, particularly FPI investment. So they're ready to pour the money in India. They're saying we'll receive record-breaking FII money. Along with the domestic institutional investors, DII and FI money is going to basically strengthen the rupee against the dollar in the coming year. So we may not see a lot of slide happening in next year. If the analysis, their view comes true. Okay, their belief comes true that we'll have a lot of money, though we are having trade deficit, around about $15 billion. Our imports are very high, exports are less. There is a gap of about 10 to 15 or $20 billion, which makes our rupee always depreciate against the dollar. Okay. And of course, the underlying is the interest rate differential because interest rates in India are higher and America is lower, and thereby the inflation is lower in India, higher in India and lower in America. So that causes a shift in the dollar becomes an appreciating currency most of the time. Okay.
So just a question to this: that in this the premium is decreasing.
Yeah.
So can we conclude as per this that the market is believing that the dollar is going to reach to 86 by 29th of January?
No, it's not. Nothing like that. It's not a belief. This is a strike price. Purely you have to choose. It's not signifying anything. According to me, it's not signifying anything.
Because the premium upon 86 is the lowest.
The lowest, because it's the lowest because the chances of 86 are going to be the least. So people know that 86 में होगा तो premium तो अब free में तो कोई चीज देंगे. It's almost like free, Point.
This premium ज़्यादा होना चाहिए जब यहाँ likelihood थोड़ा कम हो, risk ज़्यादा होगा.
हाँ.
ऐसा नहीं होना.
हाँ होना चाहिए बट इसके अंदर इसमें ये स्ट्राइक प्राइसेस है. ओके, लेट्स मूव फॉरवर्ड एंड विल कम टू दिस अगेन दिस क्वेश्चन. लेट्स पार्क इट फॉर अ व्हाइल. ओके, अदरवाइज विल बी जस्ट हॉवरिंग इनटू दिस क्वेश्चन एंड मिस द मेन बस. बट इसमें कुछ वो नहीं है जो वी आर ट्राइंग टू रीड अभी तक. हाँ, या absolutely. So a person like we have chosen at the money option or near the money option. We have not gone and selected 86. Fine. अगर उसका कोई ऐसा सिग्निफिकेंस होता तो मैं 86 कर लेता. अभी तो 83 है. Why should I choose 86? That means I am taking the it is basically that I can shoulder 3 rupees risk on myself. The rest of the risk I am worried about. इससे ज्यादा risk मैं झेल नहीं पाऊंगा. So let me cover it. I pay 250. If the dollar goes to 87, I will be paying at 86 plus the premium that is just 0.02. So I am hedged at 86 points. So here the meaning is only that. The meaning, according to me and my understanding, is that rest of the risk you can take on your shoulders, and बाकी risk आप pass on hedge कर लो. That is only the story which is coming out here. Okay, fine. So what happens is now 29th of January happens, the expiry day. Okay, I have to make a payment on that day to my importer. So banker will come to me and he'll say that you have to make a payment of $1 lakh, and the rate is 84.50, so spot rate. Now this is the spot rate announced by RBI. The spot rate will be similar, almost similar, offered by the banks. Okay, banks can always charge a little higher and more. That is because they'll check the interbank rate on that day. Okay, they don't know what is the RBI rate. So the RBI is also checking the interbank rate and then adding some normal margin and putting this rate to you, giving the rate to you. So this can differ from few paisa here and there, not more than that. The spot rate may be, actual spot rate may be 84.51 at which you have to make the payment. But we are assuming that the RBI rate is a spot rate without adding any complications. Now, in this case, because the rate has gone up, the dollar has gone up to 84.50. So I'm making money because I have chosen a strike price how much? 83 rupee 25 paisa. Okay. So as a call buyer, I have an option to exercise. The call writer doesn't have an exercise right. Okay. Fine. So I will exercise my right and I'll make money because the dollar price was 83, strike price was 83.25 and dollar today is 84.50. So I am making a gain of 1 rupee 25 paisa, which translates into 1,25,000. But I had paid a premium of 23,000. So my net gain will be, so the writer is going to get 23,000 and then he's going to pay me 1,25,000. So net outflow from the writer will be 1,02,000. Inflow to me will be 1,02,000. Inflow and outflow will match. Okay. Now the banker, he calls me and he says that, your rate is, you have to pay 84,50,000 because since now the supply day has come and you have to make the payment to the importer. So you're going to make the payment at 84,50,000 because the spot rate is 84.50. But what is my, actual outflow? My actual outflow as a customer or as a company is 84,50,000 minus 1,02,000, which I have gained in the stock market. So my outflow is 83 rupees 48 paisa. Sorry, 83,48,000 minus this. So if I calculate, it comes to 83.48 rate per dollar. That means, taking 83,48,000 divided by 1 lakh, I get 83.48. But if you have to theoretically check whether this is correct, so whatever is the spot, whatever is the strike rate, I'll add the premium to it and calculate that is coming to 83.40. That is what I have paid. Is that okay? So the strike rate plus the premium is my hedging rate. Is that okay? And that is what I'm paying. Now, the other option would be next case, instead of dollar appreciating, the dollar is, gone down. So here I'm not going to exercise my option because I'm happier one way because I have to pay less amount to the importer now. Okay. So I will just walk out of the contract. Either I will not exercise my right or I can say I have walked out of the contract or the option has expired, worthless. There are a lot of, phrases which I use. Either I'll say I'll exercise the right. Okay. I will not exercise the right here. So that means I will walk out of the contract or option has expired, worthless. Okay. Now I lose 23,000. The premium which I paid, the writer is, I have already paid to him. So writer is happy. He will pocket, he knows now the money belongs to him firmly because the dollar has come down. Okay. Fine. So importer will pay 81,75,000. The banker will call up and says today is the date. Make 81,75,000 rupees because the spot rate is 81.75 and you have to pay $1 lakh. So give us 81,75,000 so that we can remit 1 lakh to your supplier. Okay. So that means your total outflow is how much? 81,75,000 plus 23 rupees premium. So in this case, you get the appreciation. Here you never wanted to exercise the option because the rate has come, but you have paid that premium. Okay. So here you can choose, if it goes in your favor, exercise the right. If it doesn't come favor, walk out of the contract. Okay. Is that okay? अच्छा हाँ वो गलतियाँ थोड़ी थोड़ी हो जा रही हैं 98,000 है अच्छा keep checking because I keep making some mistakes the last 3-4 days I've huh so I keep updating because every 3 months I'm giving a lecture somewhere and again because lectures are not that every time I'm teaching derivative I'm teaching so many subjects sometimes GST sometimes other things the subjects keep changing. Okay, so maybe after 3-4 months I again start teaching derivatives, so I have to update my slides. Okay, so assume now the rate is 81.75. The second case where the dollar has come down to 81.7. So this we have done, na? हाँ, ये तो कर लिया. So I just made an addition. Okay, is that okay? Now, just understand there are 4 guys: call writer, call buyer, call writer. Put buyer and put writer. So first we'll do put and then we'll talk about all the 4 so that you can understand. So we'll come to this hedging strategy also, so which I am going to explain today. So now earlier you were an importer, now you are an exporter. Okay, fine. So you are an exporter. So what we'll do, so you check the screen on 22nd of December. So you have to make a 1 lakh rupees payment, but now you have to make the payment on 27th of February, not in January, but February. Okay. And 27th February, I mean, it happens to be the expiry also. Okay. So I've chosen the rate so that it synchronizes with that. So then you go to the market and check the strike price. So various strike prices are available. So you choose 83. So now, just go and check the strike price. So these were the strike prices which are available on that day. Okay. You're buying a put option now. Instead of buying a call option, you're going to buy a put option. So here you will get a right to sell your dollars. So you want to know that I will sell the dollars today itself, okay, at a certain price. So you're assured about that price. So you check the price. The dollar is today at 83 rupees 17 paisa, okay, the spot rate. So you check the rate that you can choose 82 from 82 to 84. So these were the various kinds of strike prices which are available on the stock exchange. I'm not going to stock exchange because we have gone once, so we'll go again later on. So you check the strike price, it's 82. So 82 to 84. Now, if you choose 83, it is close to the current spot price. It is at the money or near the money. I'll show you that there in the ICI it's written NTM, not ATM. They say it's near the money. So a couple of them they say near the money. They don't use the word ATM. ATM is it is right at the spot rate. Okay. So I can also use the word ATM instead of NTM rather than ATM. Okay. So now what happens is that it again depends if I choose 82, which is out of the money. Okay. If I choose 82, the current price is how much? 83 rupees 1.7. So my profit will begin from 82. No.
From the 83.
80?
It will be in the money when the dollar depreciates. No, when the rupee depreciates.
No. Just listen. Just my first one is 82 is out of the money. Fine. It is out of the money. And today the rate is 83.17. Fine. So if I'm choosing 82, if the spot rate on the expiry falls below 82, I'll start making money. Is that okay? So if I choose 84, okay, then my profit will start from 84. If the dollar goes to 82, I make 2 rupees gain. So that's why it is in the money. Is that okay? Dekho, if I choose 82 today as a strike price, the dollar is today at 83.17. So I'm choosing, 1 rupee 17 paisa below the, the current spot rate. So that much of risk I'm taking on my shoulders. As an exporter, if the dollar rupee appreciates or the dollar depreciates to 82, first it has to depreciate to 82 first of all. So that depreciation I'm taking on my shoulders. Okay. So that means I'm taking some risk on me. So that's why it's OTM. If I'm not taking any risk on me, then, if I'm taking 84, okay, so I am actually taking an advantage. So my profit will start it from 84. So suppose the dollar goes to 81, I'm going to get 3 rupees gain, isn't it?
Sir, you mentioned about the call option that we need to choose a strike more closer to the spot price.
Yeah, here also, yeah.
So, in case of put, I believe that like we can choose more in the money because of the trend of
Okay.
appreciation of the
Fine.
currency.
So your question is valid. So when I take out the Excel sheet and you can just play around and see where you are making the maximum money. So there the choice will be yours, okay? And you can try various these things on the screen. I made it, completely, formula driven, so you can do that. So let me say that I'm choosing at the money at the moment. So I've chosen 83 where the premium is 20,500 because I choose more deep in the money. Then I have to pay 79,500 premium. Mind you, it's become very costlier. Okay. Okay. So that was the only reason. But let me check. We'll check. You can decide yourself what should be the right price when you go and make it.
Buying put would be less costlier, but if I'm selling the put, then I think in the money would be better.
Hey, you're not selling it, you're buying the put. Selling the put is your writer.
Then
Okay.
at the money.
Yeah. So let's stick with 83 rupees and then we will see your point of view and see how it works. So here the premium was 20,000.2050 per dollar and you have to pay 20,500. Okay. Which is near the money. Okay. So now there can be various cases. Case one, assume the dollar has come to 82 rupees. Okay. So when I placed the order, it was 83 rupees something. I choose a strike price of what? 83? 83 exactly. So the dollar rate is 82. in profit of 1 rupee, isn't it? I'm making gain because I have sold dollar to someone at 83 by Lelo 83, and today rate is 82. So I'm giving somebody costlier, whereas the rate today is 82. So I'm making a 1 rupee gain, fine, and he is making a 1 rupee loss because I have already sold to someone a month back that I am going to, or 2 months before, in month of February, I'm going to sell at 83, but the rate has come to 82. So I'm in a winning position. Okay, I'm in a winning position. I'm gaining one. So what I'll do, I'll exercise my right. ठीक है भैया, 82 में मैं I'll go and this thing. So I'll gain here 1 rupee. Is that okay? But I have paid a premium of 20,500. Okay, fine. Had I chosen more deep in the money, I should have paid 79,000 here. My gain would have been limited. Okay, fine. So that was the only thing. Unless you are thinking that it will go to 80 or something, then you can have a good amount of profit if the dollar doesn't move so much. Fine. So that is this reason that you always stick around at the money or near the money. Now exporter will receive 82 lakhs. Okay, the rate was 83 rupees. The spot rate was 83 rupees 17, but I'm receiving only 82. But I'll get 79,000 as a profit from the stock exchange. So I'll be hedged at 82.79. Remember the spot rate was 83.17, but I'm receiving at 82.79. So some risk I'll still have. But now how do I calculate? The strike price minus the premium, because after the premium, if I minus the premium, maximum, that will be my gain after that. In case of a call option, it is the strike price plus the premium. In case of the put option, it is strike price minus the premium, because anything falling below that level, my profits will start coming out. फाइन, जब तक वो 83 रुपी से माइनस होकर नीचे नहीं जाएगा तब तक मुझे प्रॉफिट नहीं होगा. फर्स्ट आई हैव टू कवर द प्रीमियम. फाइन, स्ट्राइक प्राइस ऑफ 83 आई चूजन, इजंट इट? तो 83 में मैंने प्रीमियम भी पे करा, तो मेरा उससे नीचे और होना चाहिए. तो प्रीमियम तो पहले मैं रिकवर करूंगा ना. तो पहले जो फॉल होगी, सपोज इट फॉल्स टू 82.79, इट्स माय ब्रेक इवन पॉइंट. Suppose it comes to 80, the price closes instead of 82, it closes at 82.7950. I'll still exercise my right and get 20,500. So 20,000 will be my gain, 20,000 my premium. So I'll not make any gain or loss. Is that okay? So first I have to recover my premium. So the price must fall below the strike price minus the premium to start making me profitable. Okay, so that's why my hedging price will be 82.79, which is the strike price minus the premium. Is that okay? Now let's talk about the case 2. Case 2, the dollar goes to 84. Fine, who I am? Exporter. So otherwise I would have not hedged, I would have been very happy. But here also I can choose not to exercise the option but lose only 20,500. So I lost that, but I got 84 lakh rupees from my customer. I mean via the bank, because bank rate was 84. He paid $1 lakh, the same amount, but I got, in rupee terms, I got more because the dollar was 84. So I got 84 lakhs. But the net was 84 lakhs minus 22,500. Is that okay?